Okay, so the students that were here today got a little bit confused when looking at the supply side policies linked to the free market. So the reduction in national minimum wage or the trade union reform. And what I was trying to make it about, which I was getting confused about and confusing all of you, was actually reduction to benefits. So the reduction to benefits one, as a supply side policy, would reduce the disincentive to work. Which would increase the incentive to become willing and able to work. And then at that point, the workforce size would increase. And if the workforce size increased, the quantity of labour would increase, which would increase productive capacity. And if we increase productive capacity, then we will have a shift right in LRAS, which would lead to an increase in long run aggregate supply, and that would give us reduction in the price level, increase in real GDP, which is effectively another way of saying a rise in the growth rate. So that was the one that I was getting confused. The national minimum wage and reduction in trade union reform isn't a quantity thing, and I was getting it confused. I don't know why. So both of those things would mean that workers felt less secure in their jobs. So if you reform trade unions, the trade union power falls. So it would be more likely that you would have, you could lose your job, or businesses could get rid of you quickly. Reduction in the national minimum wage would again make people feel less secure. The theory then goes is that people will increase their productivity, because that's the only way that you would potentially get higher wages in the future, or to guarantee your employment. Now, becoming more productive, it's almost implying that the quality of labour would improve because there is a greater incentive for productivity. So you almost choose to become more productive, and that would then mean that the productive capacity would increase. And then you've got the same analysis over here. So that's a very kind of free market, Hayek point of view of workers are inherently lazy, and if you make them feel less secure in their work, then they are likely to work harder. Some of the reasons why that might not work is actually that there is an opposite point of view of paying people more and giving them more job security means that they feel more motivated because they feel the business is looking after them, and that would be the thing that would increase productivity. In terms of the reducing benefits, like Alex said today, your go-to ineffective supply side policy is the one where aggregate demand is already low. So in that situation, there would be no increase in economic growth because real GDP hasn't increased, and as Marcus said, what you've effectively done is increased the output gap from 1 to 2. So you've increased the negative output gap. And just to refresh that it depends upon, if you go for that argument, your it depends upon is demand side policies such as monetary or fiscal, and say there needs to be a coordination between interest rates or expansionary fiscal policy, such as lower VAT or higher government spending, and then what that will do is increase real GDP, as now the actual macroeconomic equilibrium has increased. Another exam question that we didn't quite get a chance to have a look at but does link into development. Assess the significance of 3 factors, but it could just be 1, it could be 2, which might limit economic development in developing countries. So here we are looking at any of those problems that developing countries have. So a question which might talk about limit development, or problems with development, or holding back development, or reasons why countries are less economically developed, is really looking at any of those factors that are problems or the reasons why a less economically developed country is not developed. So in terms of our K mark, it is about non-material well-being, and you could link it to, it's measured by the HDI, which looks at GNI per capita, PPP, life expectancy, and one of the measurements of education, either mean school years or average expected school years. Okay, so you've got numerous ones you could go for, such as lack of education or primary dependency, debt, poor financial infrastructure, lack of savings, poverty, poor health, lack of foreign reserves. So just taking the various ones here, if we're going to go for the primary dependency argument, we could talk about how they are low value added products, that they are volatile prices, that they tend to have inelastic demand, and that they tend to lead to poor terms of trade because the imports tend to be luxury and higher value added, so over time you would have a deteriorating balance of payments. Then you link that into low incomes, and either we link the incomes into the development from the inability to spend on other things such as health and education. An evaluation for that one would be, however, it depends upon the demand for primary goods, because Russia, for significant amounts of periods, due to the demand for oil, meant that the value of the exports is greater than the value of imports. So you can end up with a balance of payments surplus, and if you use that well, it could lead to development. Debt, the most straightforward way to go through debt is to talk about the high level of debt for a government. So we talk about it in terms of government debt and debt interest being high. What that would reduce is government spending in the short term because of the repayments, which would mean that there would be a lack of human capital infrastructure, such as hospitals or schools, and then you can link that directly to the HDI in terms of those life expectancy and education measures. You could say it depends upon whether it was capital or current spending, because if it was capital spending, it might be that they've built infrastructure and it's going to take time for that infrastructure to be used. So lastly, poor health. Well, this one's pretty straightforward because it's just going straight to a lack of life expectancy. But you could also link this one into economic growth, because the poor level of human capital may mean that they have low paid jobs, which would also link into poverty. And then that would mean an inability to improve in the long term in terms of the Harrod-Dover model. In terms of poor health, you could evaluate in terms of the extent to which, so if for example there is already high unemployment, then it might be less of an impact because the poor healthcare would decrease long-run aggregate supply, but it might not affect economic growth, and there might still be potential capacity to grow. If the economy was already quite close to full capacity, and it still had a low level of development, then that poor healthcare would also be inflationary, and that might be a second negative impact, so affecting or keeping incomes low, but also increasing prices, so standards of living deteriorate over time as well. Just linking back to development and supply side policies, if you are going to use the Harrod-Dover model, you can use it to explain economic growth through supply side policies, or you can use it to explain why a policy could lead to economic development. So one of the key stages is saving, which goes into banks, which is then reinvested into the economy through businesses. The businesses will buy capital, so the value of capital will increase. So that is the capital accumulation part. So this is the kind of spending, monetary spending on capital. And then the last stage is output and income, and again the value of output and income. And then some of that income is saved, some of that income is spent, but if there is more income in the economy, then there can be more saving. If there's more investment from businesses, there will be more physical capital in the economy, which allows greater outputs and incomes, and then the economy grows. So this is from the part where there's an assumption that economic growth equals development. As it's got investment in, it's a long-run economic growth model. So the key theory there is that long-term economic growth is based on domestic saving. And even if it's FDI that starts the model, it's just to allow more domestic saving to increase, to allow more domestic investment. The capital output ratio being low was key, because that meant for every $1 or £1 invested in capital, you got a greater amount. So it's low to high. So it's the first one that's low, capital output ratio low, $1 to $2 beneficial. A stronger exchange rate makes capital accumulation easier, because the capital goods will tend to be coming from abroad. And at this point, trying to stop capital flight is also key, because if that money is saved abroad and it doesn't end up in domestic banks, then that will hold back the investment. Okay. This question looked at debt cancellation as a development policy and trade liberalisation as alternative means of promoting economic growth. So the significant conclusion here, or the EO4 level 3, will be about which of these two policies is better. So if you went down trade liberalisation, you are going to look at reductions in tariffs and quotas. So you could do a reduction in tariff graph there, and analysis would go with that. You could do it from the benefits domestically of cheaper goods, or you could do it from the agreement through trade liberalisation of reciprocal reductions in tariffs and quotas, so that you would be putting down your tariffs and quotas and your trading partners would be putting down theirs. So potentially your exports will increase because they will become relatively cheaper, and then you're linking it to balance of payments improvements, increases in aggregate demand, economic growth, and then linking growth through to development. The reasons trade liberalisation might not work is if you are primary dependent, or if your infant industries are wiped out from things like dumping, so cheap imports wiping out domestic industry. Debt cancellation would reduce government spending on the interest repayments, which would allow government spending on health and education to increase, or infrastructure. Then that would improve the HDI, as you've got a greater quality workforce, and increases to HDI would also increase economic growth and development. In terms of why that might be less effective, you could link it into that kind of moral hazard, that you are rewarding poor government spending. There might also be corruption, and you might end up again with greater debt than before. So there might be an incentive to take out more debt, not spend it wisely, and potentially waste resources, so that there might be no increase in aggregate demand or aggregate supply. This question, it would be an evaluate question. So evaluate to what extent do the costs of globalization outweigh the benefits. We could make this a trade question again. So you could talk about it in terms of trade liberalization and the benefits of free trade through lower priced goods, higher quality goods, greater choice of goods, increase in export-led growth. You could focus on comparative advantages here and talk about how specialization in comparative advantages would allow a country to increase its total consumption because they will produce more domestically, and trading partners will produce more domestically, and then we will trade the difference between the two. And what we should end up is a greater number of goods in both countries at the same time. You could talk about it from an efficiency point of view, in terms of that the businesses through specialization will become more productively efficient, and then through the specialization they will be able to increase their output. In terms of the negatives from that, you could talk about negative externalities of trade. A key, one of the most straightforward arguments for negatives or arguments against is that globalization itself increases inequality. So what you have is that the people who own the capital, or the owners of assets globally, tend to get a much greater return, and people on middle or lower skilled jobs, they lose their jobs to the lower paid people around the world. And as there is a greater supply of those, average wages for the bottom end tend to fall. So the wages at the top go up, the value of assets at the top go up, the wages at the bottom go down, and there's a lack of assets there. So there is a growing global inequality due to globalization. If you're going to say to what extent globalization the positives outweigh the benefits, you can bring it down to market failures. So there is an argument that because there are market failures, that without government intervention to redistribute wealth through progressive taxes or through progressive subsidies, that would solve the market failures, the inequality. You could link it, if you've done negative externalities, of being government intervention to reduce emissions. You potentially, if you wanted to argue for the free market, could say that not every country has fully signed up to trade liberalisation, and until that point the benefits of free trade might not be felt. This question is looking at foreign direct investment. So in 2014, China received 129 billion foreign direct investment, and Brazil received 62 billion. Reference to examples of the specific countries evaluate the potential benefits of inward FDI. So there's a bit of a clue there in the word inward. We've got two different figures here, which should give us a nice opportunity to evaluate. So inward FDI is spending on capital goods by foreign multinational companies on domestic factors of production, or domestic capital goods. The benefits of FDI are just the benefits of investment in general. So an increase, or in fact we could use the Harrod-Dorn model here, talk about capital accumulation, talk about a reduction in the capital output ratio, increases in incomes, greater value of saving, which allows more domestic investment. Could draw a long run average supply graph showing the effects of that. Potential benefits are long-term economic growth, and we've already mentioned the rising income, so we've got that as well in there. Negatives of foreign direct investment can be, if you link it back to the leakages, and if you talk about the dividends or the profits leaving the country, and that would be a negative in the balance of payments as well. You can talk about it in terms of if it's capital intensive, so this means that there would be a lack of actually jobs created. So the part about greater incomes might not happen. You could also talk about that foreign multinational companies might evade or avoid taxes, and then the government gets zero corporation tax and therefore doesn't have the ability to lead a development. In terms of the it depends upon, one of them is that if you're going to go for the free market and encourage FDI, you might be able to kind of incentivize reinvestment, so that they reinvest the profits, and that then would give the size of the benefits, or more to keep the benefits domestically. In terms of the size, so it does mention like 129 in China and 62 in Brazil, but it depends upon it as a percentage of GDP. So if it's a large percentage of GDP, then it's going to have a significant impact. But if it's only a small percentage, it'll have less of an impact on. Because it also mentions inward FDI, it also depends upon outward FDI. So one thing that China does do is that it does a lot of outward FDI. So one way you could look at it is there a net import or export, or a net, sorry, better way to think of that, is there a net leakage or injection from FDI? And again, that will determine the extent of the benefits. You could potentially also look at maybe ways in which the government might try to encourage labour intensive rather than capital intensive FDI. Okay. So first question here, assess the causes of absolute poverty. The cause of absolute poverty, I want to define it first. So people living on less than $2 or $1.50 a day, depending on the measurement you look at. In terms of development, you could have it as a lack of skills, and if you've got a lack of skills, then you're going to get a very low paid job, at which point you are going to be living on a very low wage. A very good one is a lack of capital goods within a country. So in Africa, if we're going to apply this, you have subsistence agriculture, which is you just produce enough for yourself. So it links into the basic economic problem. You can only satisfy your needs. And because you don't have capital goods on the farm, your farm output is very low, and that's why your income is very low. So it's reasons for income being low. But if you look at the top one there, the lack of skills, low paid job has only a very few number of steps in it. A lack of capital goods, application to markets, just meeting needs, output being low, and less income because of that has a little bit more involved in it. You could compare the reasons, so looking at which one is more or less significant. So you might say that the lack of capital is more significant because a low skilled worker with capital might be able to produce a greater output, but a high skilled worker without any capital won't be able to produce much of an output. You could also make it about time. If you were looking at kind of other factors about healthcare and things, you could say that education in itself may be a very long-term thing to solve. You could say it depends upon the level of lack of education. Some people might have only been educated at 10 years of age. Some people may be 14. So the first question there about reducing the number of people in absolute poverty, one way of thinking about reducing absolute poverty is that it's going to increase people's incomes. So if you've reduced the number of people below $2, you're going to increase the number above, so there'll be an increase in income. This is the one where you do development, linking it through economic growth. So an increase in economic growth due to an increase in aggregate demand, because consumer spending would increase from those greater incomes. So again, just an ADA-LRAS graph showing that increase in consumer spending. You can then link it onto either increases in education spending because the government tax revenue increases, and then that leading to an improvement in non-material well-being. In terms of why that might not achieve it, is because growth in itself might lead to, or it might, you might get a number of people on low incomes going from, say, 1 million people on less than $1 a day to 500,000. But at the same time, the number of people on high incomes, or the people who are at the top, might have increased their income as well. So actually you might have increasing inequality, and that might lead to a reduction in development. You could also say that there may still be other significant things, so it might depend upon whether the government has debt, and the increase in that tax revenue actually just goes to pay off the debt rather than it being used for education purposes. So what you're probably going to talk about is that reducing poverty in itself might not affect growth, or might not fully affect development, if there's not a significant increase in the infrastructure, of health or education or transport from the government. So you might look at kind of what policy was used to give people that extra money, because some of those policies might have an opportunity cost if it is giving them more money but then also improving the supply side as well. In terms of education and health, then yes. But if it's just about consumer spending in the short term, potentially no. Okay, these are a few quick questions that were in the pack as well. What's meant by real gross domestic product? Well, real is adjusted for inflation. Growth is an increase in your gross domestic product is output, income, or expenditure. Reference extract 1, outline how ILO unemployment is measured. So both of the measurements are about people being willing and able and actively seeking work. The ILO measurement is a survey of a sample of households who say yes to that question. Are you willing and able and actively seeking work? And then that sample is used to extrapolate to the whole of the workforce. Explain what is meant by an output gap. So an output gap is the difference between the level of aggregate demand and aggregate supply. Just giving an example, if it's a positive output gap, then aggregate demand is greater than aggregate supply. If it's a negative output gap, aggregate demand is less than long run aggregate supply. And if in doubt, graph it out. Just show either a negative output gap, and if you want to label that, you just put income at full employment, and you say the difference between Y to YFE is the negative output gap. With examples from extract 2, what is meant by capital expenditure and transfer payments. So in the lesson we looked at transfer payments. These are the payments in terms of benefits which don't affect AD because they don't create an injection as it's cancelled out by the tax that's taken up to pay for it. So we just call it a transfer payment because it's a transfer of money between people within the economy. Government capital expenditure is spending on physical capital such as infrastructure, so roads, which increases the productive capacity of the UK.